Hi, everyone. I'm Sarah Samuels, Partner and Chief Investment Officer here at NEPC. I'm joined by five colleagues who oversee manager selection across asset classes. We have Will Ford, Partner and Head of Marketable Securities, Josh Beers, Partner and Head of Private Equity, Oliver Fadley, Partner and Head of Private Credit, Dilari Pancholi, Partner and Head of Credit and Diversifying Strategies, and Matt Ritter, Partner and Head of Real Assets. So we've seen some dynamic shifts in the markets, and investors are confronting some common themes that you'll hear throughout each of these parts of the market today. We have a mega theme of convergence and a blurring of lines, and that's happening across two vectors, between public and private markets and between institutional and wealth investors. So you'll hear from us about crossover vehicles, semi-liquid funds, ETFs, and the rise of wealth. AI is a major accelerant for nearly all strategies. We see extremely narrow market leadership in public equities and private equities alike, which has made active management challenged. Another theme is pressure to sell, or better yet, pressure to transact, especially in the private markets. And this creates opportunities on both the sell and the buy side. You just have to be on the right side of it. This relates to liquidity challenges for both LPs and GPs alike, which have led to lots of creative liquidity tools, continuation vehicles, LP secondaries, NAV loans, and more. Secondaries are now a primary tool. This is a major theme this year. Secondaries are a primary tool now. LPs are deal people now. It's a new skill set for many. In a period of rapid innovation in market structure and deal-making tools, sometimes it's okay to be boring. In some areas, you won't get paid to stretch for returns. We think this is a great time to be a provider of capital, either as a lender or a secondary buyer in certain spots of the market. And we do expect dispersion between the winners and the losers and the haves and the have-nots to be much wider going forward in the future. So manager selection is going to matter more than ever. Finally, successful investors today need a CIO mindset to think through how these convergences will impact their returns going forward. So let's kick it off with Will as head of marketable equities. Active management has been challenged across the board, especially for fundamental concentrated strategies. So how do you recommend guiding clients through periods of underperformance and avoid buying high and selling low?
Well, overcoming investment bias is really a cornerstone of our investment process here at NEPC. This is a uniquely challenging period for active management, just given the concentration in many equity indices. We've actually found that nearly 15% of active global equity strategies are underperforming by more than 2 times their tracking error. That's a real outlier relative to the long-term average of 2%. As part of our process, we use a variety of tools and frameworks to, one, unpack signal from noise when evaluating a manager's track record, and two, to proactively re-underwrite underperforming strategies that may be outside of our range of expected outcomes. And lastly, to importantly coach our clients through really rough patches like these.
So how does this theme of convergence impact your view of equity market investing?
Well, with the rise of wealth, we're likely to see continued and steady increases in passive assets, both from passive ETFs, which have now reached $15 trillion in assets, as well as target date funds. With that, we need to be really mindful of the impact that these flows may have on the securities our active managers decide to hold or maybe not hold, and the volatility on the broader market more generally. In some ways, the growth of private wealth assets actually reaffirms our active management views in certain asset classes. We also get a provocative question from clients quite a bit around whether they should get rid of all of their US small cap equity exposure and replace that through private equity buyout programs. We've explored this topic in a recently published research paper with our findings. And essentially, while companies are definitely staying private for longer, we believe there's still room for both exposures in the portfolio, and they're actually quite complementary.
How do you recommend investors structure and implement their public and hedged equity portfolios going forward?
Well, In the US small cap space, we continue to take an active approach with a quality focus, and that's to hedge against any downside risk, given the index has a disproportionately high percentage of non-earners. We also believe that small caps should benefit from continued quantitative easing and any uptick in M&A activity. Within the emerging markets, while risks definitely still persist, we believe it remains too large for investors to ignore. Given the volatility associated with the emerging markets, selecting the right type of active management is really important. Understand the performance profile of a more diversified versus concentrated approach. And lastly, we think clients should consider complementing this allocation with emerging market small cap. Within the long short hedge fund space, we see growing opportunities within healthcare and biotech, which have already started to show signs of life. We also are considering a number of long-only strategies from really successful fundamental long-short funds as a potential new source of ideas in a public market space that seems to be evolving by the second.
Josh Beers, turning to you as head of private equity, we see some common themes between public equities and private equity, which makes sense because the two are inextricably linked. One theme that comes to mind is convergence and the blurring of lines. So can you just comment on how this is manifesting in private equity?
Sure. We're seeing it in two ways. The conversion showing up for private equity. First, public and private partnerships that have been forming over time. And the second place we're seeing is increased momentum in semi-liquid, evergreen, and interval fund structures, which we expect will likely have implications on co-investing deal flow going forward.
All right, so pressure to sell is another theme that we highlighted, and we see that in all of private markets. How are LPs and GPs alike affected by the strained liquidity in today's environment?
Well, first, LPs are struggling with their pacing plan assumptions. We embarked on a deep exercise of reviewing our own pacing plan assumptions based on data and the experience of our clients' 100+ private market portfolios. We did publish a piece on this topic, which is on our website, but the punchline is that pacing plans should adapt in lockstep with the shifts in private markets. And then, as part of the lower distributions being received by LPs, LP-led secondaries have become a primary portfolio management tool. It was once stigmatized practice. It is normal and healthy to price one's portfolio with a broker periodically. And lastly, LPs are deal people now, as you said earlier, Sarah. Continuation vehicles continue to be a favorite tool for GPs. We saw a major uptick in CV, in deal volume, in dollars, in count in 2025.
So what do you recommend LPs do in 2026?
Yeah, so beware of tail-end funds in your program. Explore secondaries on both the buy side and sell side. NEPC can help introduce clients to secondary brokers who are experts in pricing private market portfolios. Lastly, NEPC is going to stay dedicated to continued focus on the lower middle market for buyouts and early stage venture, including seed stage managers for venture.
Oliver, as head of private credit, as we think about this broad theme of convergence, private credit is perhaps the most exposed to this theme in the direct lending space. Semi-liquid interval funds are growing quickly. So tell us how this theme of convergence is impacting pricing and quality of deals in direct lending, and how does this relate to some of the other themes you're seeing in private markets and how clients should play them?
Yeah, absolutely. So the growth in private credit AUM continues. It's driven primarily by new entrants, and as well as new markets and further consolidation. And this is playing out in a couple different ways. On the new entrant side, including private wealth or retail investors, as well as insurance companies, they're significantly shaping the private credit markets, including a sharp rise in evergreen or open-ended vehicles as GPs look to address this newer segment of the market. Credit GPs have been pretty active in selling existing portfolios, as well as they look to crystallize performance or make distributions to LPs, enter these markets, including private wealth and retail. In addition, on the GP consolidation side, you're still seeing that as being a big contributor, as acquired firms are typically under pressure to raise more AUM and deploy more capital as part of the transaction. And not a surprise, one avenue is through these private wealth and retail areas as well. And then stated earlier, with the significant uptick in the number of these semi-liquid or more open-ended private credit funds being raised, a lot of them are actually being allocated to more liquid and public credit, more so than maybe some investors realize. And that's really used to help manage some of the liquidity and implementation constraints that come with these funds. So investors should be aware of exactly what's in these portfolios and the quality of those companies. And as you're alluding to on the secondary side, now it's being more used as more of a primary tool. We're actually seeing a pretty good time for LPs to sell their larger direct lending exposures because of the pricing that they can receive and invest in the smaller end where we're seeing bigger discounts, but overall healthier portfolios. And I think related to your second question, related to this, but in a similar vein, LPs should be cognizant of the overall status of the credit markets. What we're highlighting is this theme of appearance first reality. So on the surface, larger deals are getting done, the capital markets are open, rates are coming down, the economy seems to be chugging along. But below the surface, the optionality for refinancing more limited. The optionality for refinancing is much more limited. The capital markets are really open for these larger companies, especially the higher quality companies that are being banked by larger bulge bracket banks. So unless you're really kind of that larger, higher quality company, you aren't seeing the access to traditional financing that you historically were. And there is a stress below the surface that's building, especially in certain segments and industries, as well as the lower quality segments of the market. I think one really good example is in the headline default rate. The headline number is around 1.4%, which is historically or seemingly low. When incorporating things such as distressed exchanges or debt for equity swaps, that number almost triples to about 4.5%. These areas of stress include the upper middle market LBOs, these loans that were done in the 2020 to 2023 vintage years before the rate hike or experienced the rate hike shortly thereafter. Middle market orphaned assets, you're still seeing some distress in the commercial real estate space, as well as some segments of the CLOs that happen to be in over-leveraged sectors. But this is an area where we do feel that managed selection is particularly important because there should be a pretty wide dispersion of outcomes depending on their capabilities. And so I guess to sum it up, why does this matter and how should clients play this? Today, we feel that investors today will get paid for complexity, not beta. The illiquidity premium will no longer be driven just by spread. It'll be driven by, again, complexity and specialization. And we're really focused on strategies that can do both financial restructuring and operational restructurings. So if you need to take over a company, you really want to be with a manager that actually has that long experience working through these distressed situations, as well as working across the capital structure, as well as strategies that have a historical expertise trafficking in complexity or industry and sector experts. These are areas that will be less competitive relative to the overall kind of traditional beta that you're seeing primarily in the direct lending at the upper end of the direct lending market. For folks that do want to stick with a direct lending allocation, we still like the middle market on a relative basis, but do want to highlight that also segments of direct lending aren't immune to the competitive dynamics going on in the market. We're in the process of publishing a white paper that highlights kind of our overall views on the market. But for this section, these are the themes that we're really, really focused on.
So let's shift gears to you, Dilari, as head of credit and diversifying strategies. Tell us about what you're seeing in the marketable credit space.
Sure. So public markets, remain relatively healthy. There was a brief period of spread widening earlier in the year, but the year still ended with tighter spreads, almost steady fundamentals for a large part, and it was a strong issuance story backed by AI-related companies. So, investment grade, for example, which is already almost twice in size of high yield and bank loans in aggregate, is expecting another $1 trillion in net issuance in 2026, and all this backed by AI companies and rising M&As. Same story in high yield. We're expecting a stronger issuance next year. And that's probably more related to refinancing, acquisition financing, and maybe even some AI-related overflow from IG market. So overall, high yield market is also relatively healthy. That said, it should be noted that the lower quality in high yield is not being treated as kindly in public markets. So there is definitely a little bit of bias, and the valuations already reflected. So this is probably not the time, especially within the public market context, to reach for yield in lower rated credit. Loan segment is one where we remain a little nervous. We think that the defaults might be higher relative to high yield market and recovery is lower. We are seeing more incidents of repeat defaulters, and as Oliver mentioned before, the distressed and LME exchanges can further reduce recoveries. We continue to see the convergence theme that we've heard about a few times during this session between public and private markets, as borrowers have the flexibility to tap into both markets. And in the context of overall fixed income market, the Treasury and the agency securities definitely dwarf the rest of the corporate segments. It's close to 45 trillion today in issuance, and that just provides a lot of stability and liquidity for investors in the space. So what does this mean in terms of themes for our segment? Maybe three main themes I'll highlight. One is we continue to like multi-sector approach, stay nimble, go with funds that can opportunistically allocate and have a total return approach. And they can tap into loans, high yields, bank loans, EMD, so more of a broader approach. For clients that can withstand a little bit of complexity and illiquidity, we think that there is a premium to be earned in strategies that can tap into structured credit, specifically like CLOs, CMBS, where there is a little bit of dispersion and pockets of opportunity. You can definitely earn some return in long-short credit, and finally, stress-distressed credit. And last but not the least, building on the convergence theme, we are seeing more products come our way that can tap into both public as well as private markets. Clients should know that, here you have the potential to earn higher return, but it comes with illiquidity and in some cases with credit risk.
So, Dilari, we've talked about changes in the private credit capital market structure and vehicle structures. Are you seeing any themes in public credit market structure and vehicle adoption as well?
Yeah, with the rise of wealth, story continues even in the fixed income market. The ETF market has been booming. It's close to $1 trillion just in fixed income space, based on the numbers that were published by one of the banks. In this year alone, while a majority of that ETF story has been passive for most part, this year alone we saw close to 120 billion in active fixed income ETF solutions. So the range of investment opportunity is pretty wide on the liquid side, and on the illiquid side, again, we're seeing opportunities that are on the outskirts of the private market liquidity profile with just sub 5-year term products. So investors have more ways to customize their fixed income allocation today.
Thank you. So credit and rates can be diversifying in a portfolio, but you also run other diversifying strategies like global macro, relative value, and multi-strategy hedge funds. How should clients think about hedge funds in 2026 and beyond?
Yeah, hedge funds have been another fun story. They're coming back roaring, and the assets are close to 5 trillion this year, which is another peak for that industry. And this growth has come both from strong performance across a majority of those strategies, as well as net inflow in almost every segment of that space. So what is driving this? We see two main themes. The first one is where investors have a higher allocation to equity or private markets, both return seeking for your portfolio, have reached out to hedge funds to build out portfolio diversification and kind of reduce their wall a little bit and improve the long-term risk-adjusted return. The second bigger theme that we continue to see growing was, as active management struggled a little bit and there was slower realization in the private side of the portfolio, clients started reaching to hedge funds for even building out their return-seeking exposure. So we have a house philosophy at NEPC, and that builds on that. You should use hedge funds to access and tap into market segments that you don't get in public markets. So they need to bring something unique. We don't want to pay higher fees for just tapping into beta. And we primarily use hedge funds to either build out portfolio diversification, build on downside protection, or bring a unique return stream within the portfolio. And we lean into three main frameworks that we have built for our clients that serve as portfolio construction guidance.
Okay, turning it over to Matt. As head of real estate and real assets, we certainly observe some similarities between private real estate and other private markets, themes like slower than average realizations and limited transactions. But the real estate cycle is operating on a slightly different cadence than the rest of the private market. So tell us where you see real estate today.
Yeah, the real estate market is continuing a slow and steady recovery. Debt markets have stabilized, transaction volumes have increased, and we still believe there are good opportunities for those looking to deploy capital today. So it's been slow, but it's continuing to be a positive story, I'd say, entering 2026. Supporting that is the fact that there's really been a dearth of new supply for most property types and in most markets, which provides an attractive supply and demand backdrop for new investment. We see that as asset values, have generally bottomed in the US, liquidity is returning to most markets. That said, there are still some pockets that are facing some challenges. When we look at actual investment opportunities, we see that private core real estate funds have been slow to adjust their values to market clearing prices. And therefore, we remain cautious about allocating new dollars to that segment, though there are still a few well-positioned funds in terms of both their current portfolio and their liquidity. In terms of new investment, we continue to prefer non-core real estate strategies, including opportunistic strategies, which we had been favoring the last several years, as well as more traditional value-add funds. We also like certain themes, including data centers, self-storage, and healthcare, which provide a good complement to existing real estate portfolios and also are poised to continue to experience compelling tailwinds. Looking beyond the US, we believe that Europe presents attractive investment opportunities for real estate investors. European markets have higher barriers to entry, and they have a more favorable interest rate environment, which allows for more creative financing today. Along with this backdrop, there's also the opportunity for some structural uplift through certain property types becoming more institutionally mature, something that we've seen play out in the US over the past decade or more. Furthermore, investors can enjoy a higher degree of diversity in their portfolio in terms of economic drivers, geographies, population trends, and so forth.
Matt, I really like your mantra for real assets this year, particularly for infrastructure. Can you tell us what that is?
Yeah, well, at the risk of underselling some of the opportunities, our tagline this year is that it's okay for infrastructure to be boring. If your reasons for allocating to infrastructure are things like providing stability to your portfolio, downside protection, or current income, really investors should understand the role that infrastructure is intended to play in their portfolio, and that doesn't always need to be a return-seeking type of strategy. There are some, fat pitch opportunities within digital infrastructure and energy transitions, and those have really dominated the narrative and a lot of the headlines in real assets over the past couple of years. One thing that we've seen arise from that is a crossover in strategies with many infrastructure funds pursuing deals that look a little more like real estate or more like private equity. Now, don't get me wrong, there are still some really compelling thematic opportunities across real assets. And probably the most notable of those is that the growing demand for power is real, and it will be met by both traditional fossil fuel sources as well as renewable energy. Digital infrastructure also remains a hot trend, and we continue to see attractive investment opportunities in that segment, but we do caution investors to be wary of speculative risk. But going back to the idea that infrastructure can be boring, having a sort of a back to basics view of your portfolio may provide some additional security. In particular, we continue to like the middle market segment of infrastructure. This segment has a large universe of companies and provides a better potential for both higher growth and more exit opportunities. And lastly, I would just say that investors should expect that a well-diversified infrastructure portfolio will include other sectors, things like transportation, water, and waste. These segments maybe don't have the same tailwinds as energy and digital, but they are stable, established sectors that also need further capital investment.
Excellent. Well, thanks very much, everyone, for joining us today. In summary, what you heard from our investment manager selection team today is that we've seen some shifts in the market. We really think that our clients today need to be aware of the mega theme of convergence, of the impact of AI, the impact of the extremely narrow market leadership, of the impact of the pressure to transact in private markets and the opportunities that that presents to our clients. Understanding that secondaries are now a primary tool and LPs are deal people now, and that it's okay to be boring in certain areas. We may not get paid today for the greater stretching for greater return and risk. We look forward to seeing you all at the investment offsite. We'll talk about how to employ a CIO mindset to think through how these convergences and themes will impact returns going forward. And thank you very much.